Okay, so I've got 1 o'clock by my clock, so let's go ahead and go get started with today's 1031 Exchange webinar. So thank you all for joining us today. We did a version of this webinar this morning as well, and we had a handful of people. Looks like we have a few people on today as well. So thanks for taking a little bit of time out of your day to join us. As many of you know, we are TRG's new strategic partner for 1031 Exchange Services. So what that means is for Cypress Title and Cornerstone and a handful of escrow companies down south, we are the preferred go-to 1031 Exchange partner. And myself, Leonard, I'm Leonard, and my sales team have been out visiting your offices and trying to get to know you and let you know that we are available as a resource. And part of that is conducting a quick 30-minute overview about the 1031 exchange process. I know that most of you see 1031 exchanges at your desk very often, but what we're going to do today is just a high-level overview to give you a refresher course about the 1031 exchange. So thanks for logging on. And before we get into the nitty-gritty of the presentation, I just want to make a couple introductions and let you know about a few key things. So these are your sales contacts over here at Asset Exchange Company. So this is me, Leonard Spoto. I'm one of the owners of the company. I head up the sales department and the business development department. Working on my team, I've also got Matt Ferenczi and Wei Ming Peng. So Matt and Wei Ming are part of my business development team, and the three of us are out in the field talking to realtors all day long and explaining the 1031 exchange process to the real estate community. So we do a lot of events, so we do a lot of webinars. We're always giving workshops and educating mostly real estate agents and sometimes escrow professionals as well about the 1031. So the three people that you see on your board here, myself, Matt, and Wei Ming, are your primary contacts. Our company is operated similar to an escrow office where you have sales reps out in the field, and then you also have the officers, we call them exchange officers, internally that work on the files. But we are the three main points of contact for you, and happy to talk to you anytime about 1031 exchange. Wei Ming, actually down here, he also speaks Mandarin and Cantonese. So if you have any Asian Chinese investors that feel more comfortable talking in one of those languages, Wei Ming is your guy. So with that said, let me go over just a little bit of background about what an accommodator is. Now, most of you have dealt with accommodators before, and you know that we are a required part of the 1031 exchange process. You can't do a 1031 exchange without having a 1031 exchange accommodator. But a lot of times your clients will say, well, geez, what the heck do those guys do? Why do I need one? Well, number one, it's required by law. Okay, so you can't do an exchange without a neutral third party holding the funds. So our primary purpose in the 1031 exchange process is to hold the sale proceeds from the sale of the property. If the client touches those funds, they are going to have a taxable transaction. So very important, we hold the funds during the exchange until the client is going to buy the replacement property, and then we release those funds to the new escrow. We're going to prepare all of the legal documents that are required to properly document the transaction as a 1031 exchange, and then we are going to make sure that the clients are in compliance with the rules regarding Section 1031 of the Internal Revenue Code. So that is what we do, and all exchange companies do the same three basic things. Now, some of them do them really well, some of them don't do them really well. It is our goal to do them the best. So if you have any suggestions after working with us for if something we're not doing great or to your liking, let us know, because we're always looking to improve. Now, our company, we have worked for the last couple years to put this alliance together. We worked with Neil Goley over at TRG, and he's vetted our company inside and out. But I did want to give you a little bit of background information on our company. I've been in the exchange business for 20 plus years, or almost 20 years now, but I started this company in 2016, 2006. So we've been around for a while, and we facilitate about 150 exchanges per month. So we're a medium-sized independent exchange accommodator. We are bonded and insured. And through my tax attorney business partner, we are also a member of the California Board of Accountancy and the California State Bar. And I'll tell you, a lot of our clients love the fact that we have a tax attorney on staff. And really what sets us above and beyond the competition, aside from our great customer service, is the fact that we're the only company in the industry to offer clients free audit support. Now, what does that mean? Well, if a client does an exchange, they have a pretty good chance of being audited on the exchange, especially here in California, especially if it's a very large transaction. So if they do get audited, they can go out and hire a tax attorney, which will cost them $500–600 an hour. Or if they use our company, they can call us and we will help build their case for them. Now, we can't represent the clients in tax court, but hopefully we can help them avoid tax court altogether. So we get an average of maybe about 4 people every month that get audited. They come back to us and say, hey, what do I do here? And we sit down with them. Usually it's over the phone, and we provide them all the documentation and also supporting court cases and private letter rulings that help them substantiate the position that they took in their exchange. So this audit support is really important. Hopefully clients don't need it, but it's always a nice to have when they do. All right, so let's go ahead and kind of get into the nitty-gritty of the 1031 exchange overview for today. And before I go any further, I do want to let you know, if you have questions while we're talking or while we're presenting, you can type your question in and it will pop up on my computer screen. So sometimes I get bombarded with questions, and sometimes I have to wait till the end. But we've got a small group here today, so if you have questions, go ahead and type them into your dialog box. There's a little questions dialog box, and it will pop up on my end, and I'll be happy to answer the questions that you guys have. Okay, so types of exchanges. For those of you who haven't been around the exchange world for a while, there's a couple different ways to structure an exchange. Now, the most common way to structure a 1031 exchange is what we call a standard or a delayed exchange. And that's what you guys are probably most familiar with. You're going to sell a property and you have 180 days to go out and buy one. Okay, that's probably about 95% of our business, maybe more. Okay, so most of the exchanges that happen throughout the country are standard delayed exchanges. But there are a couple other ways in which you can exchange. You probably are familiar with the reverse exchange. That is a process where you are allowed to buy your replacement property first, and then you have 180 days to sell. If you sell that property within those 180 days, that sale will be tax deferred. Okay. And then a little bit more rare, but a very valuable structure for doing an exchange can also be the construction exchange. And that is where you sell a property and use the sale proceeds to build or improve property. Now, as I mentioned, most of the transactions that we do, probably 95% of our deals, if not more, are the regular exchanges. And then the remaining 5% of the transactions we do are the reverse and the construction. So there's a couple reasons for that, and we'll get into that a little bit further into the presentation. But these two, reverse and construction exchange types, they're more costly, and they're quite honestly just a big pain in the butt. So we try to talk people out of doing those if possible. Now let's go ahead and review from kind of the high level basic requirements of an exchange. And again, if you have questions, go ahead and type your questions in. But whenever I'm talking to a realtor or a client, I always tell clients that if they can remember 4 basic things regarding the exchange process, they're going to be 100% successful. And those 4 things are, number 1, make sure your properties qualify. Okay, when you do a 1031 exchange, everybody knows that the properties involved, well, you think everyone should know, but the properties involved have to be used for trade or business or investment. Okay, they have to be rental properties, business use properties. They have to be investment properties, both on the sale and on the purchase. All right, so the properties involved must qualify. Also, the properties involved in the exchange have to be like kind. Now, this is a source of confusion for a lot of clients because they think, well, geez, I sold a rental home. Do I have to buy another rental home? That's what I heard I had to do, right? Wrong. You can absolutely buy a rental home, but you can also buy an apartment building. You could buy land. You've got flexibility in your exchange to buy and sell any type of investment property anywhere in the country. So you might have a client who's selling a piece of land and wants to exchange into a rental home. That's fine. You can exchange out of a rental home into an apartment building, out of an apartment building into an office building. Any type of real estate that's used for business or investment works. All right. Now, there's a couple exceptions that you need to know about. First of all, foreign property. Foreign property is not like-kind real estate. So if you sell in Sacramento and the Bay Area and you want to buy your replacement property in Mexico, that will not work. All right. Foreign property does not work. And then the other thing that it's very important, and I talked to one of the Cornerstone reps about one of their clients who's a big flipper. And flippers are not eligible for 1031 exchange. And a lot of people don't like to hear that, but it is the unfortunate fact and truth of the matter. If you are flipping property, you cannot exchange those properties. Generally, what happens is the IRS wants to see a seasoning or a hold period of 1 to 2 years where the property is used as an investment before it's eligible for exchange. Okay, now I say usually, and the reason why is because the government doesn't have in writing a specific number of days, months, weeks, or years where your property has to be held. Right? So nowhere in the tax code do they say, if you hold your property for exactly 24 months, it will automatically be eligible for an exchange. So they look at a variety of factors, including your intent. How did you intend to use the property? Now, you might have a flipper who bought a giant $5 million home and took 2 years to flip it. And he or she might think, well, geez, that should qualify, right? It took me 2 years. The answer is no. Because of your intent. If you bought that property with the specific intent to sell it to someone else, guess what? It's not an investment for exchange purposes. It's a flip. Development deals, you buy land, you build on that land. As soon as the building's done, you sell the property. That is also not going to qualify. Now, when you have these type of transactions come across your desk and you know it's a flip and the client says, oh, I'm going to exchange it, you can just have them give us a call. We'll explain the risks associated with an exchange on that type of property. We are not the tax police, okay? So we're not going to tell them absolutely not. They need to go through their fact pattern with their CPA to determine if they are eligible or not. Now, there are some deals we just won't work on because we know the clients are trying to cheat and we don't want to be involved with that. But a lot of times there's this gray area. And as long as their CPA is okay with it, we will facilitate the exchange. So there is some gray area, and sometimes the clients will be really aggressive in getting into that gray area. All right, so rule number 1, make sure your properties qualify. Rule number 2, and this is a really big source of confusion for clients. I get clients who call me all the time and say, hey, I'm selling a property for $1 million. I have $200,000 worth of profit. So I want to go buy a $200,000 replacement property to complete my exchange. That doesn't work, right? Whenever you do an exchange, if you want to defer all of your taxes, you need to do 2 things. Number 1, reinvest all of the cash. And number 2, purchase property equal or greater in value to your net sales price, right? So what does that mean? Okay, let's take a look. I'm going to sell a property for $1.1 million, all right? I'm going to pay $100,000 in closing costs. So my net sales price is $1 million. All right, so this building over here, my net sales price is $1 million. If I want to defer all of my taxes, I need to buy replacement property for $1 million or more. Now, that can be one property. It could be several properties, right? You can always sell one. You could buy 2. You could buy 3. You could sell 4 properties. You can buy 1. So you have the flexibility to buy multiple replacement properties or do multi-property exchanges. It's just that if you don't want to pay taxes, you need to remember, A, reinvest all your cash. So take your money from here, send it to us, the exchange company, and then use it as a down payment for the replacement property, and make sure your property is equal or greater in value. Now, what happens if you don't do that? Well, if you sell for $1 million and you buy for $900, does that invalidate the entire transaction? No. You just pay taxes on the difference. Okay, so partial exchanges are absolutely something that you can do. You could trade down in value. You could take cash out up front. You've got some flexibility. A lot of our clients like to defer some taxes, but then take some cash for themselves and pay a little bit of tax. That's not the end of the world. Okay, but a lot of people get confused because they think all they have to do to defer all their taxes is just spend their profit. And ladies and gentlemen, that is not the case. Okay, so remember these two things to defer all your tax. Reinvest all of the cash and buy equal or greater in value. Third requirement for a successful 1031 exchange, get it done on time. Whenever you do an exchange, you're going to have 180 days to complete the exchange, starting the day you close escrow. All right, that is day 0. You then have about 6 months, 180 days to go out and purchase that replacement property. Hopefully you get it purchased on or before day 180. There are no extensions given by the IRS on this time frame unless you are affected by a natural disaster that results in a presidential disaster declaration. So people ask me all the time, hey, well, I want to get an extension. Well, technically, the only way to do it is if the government issues a presidential disaster declaration, which has happened, right? In Santa Rosa last year, we had clients who were affected by the wildfires, and they got extra time for their exchange. But without that presidential disaster declaration, you're never going to get more time. All right. Even if you were sick in the hospital, you call up the IRS and say, oh, I couldn't close because I couldn't get to my signing because I had a heart attack. They don't care. Right. They want the tax revenue. So plan on 180 days. Again, starting the day you close escrow. Now, within this time frame, all the way at about a month and a half is very important, day 45. Day 45 is the day that you are going to, or the client is going to, submit their identification letter. And what does the identification letter do? Well, it declares the properties that the client is considering buying. Identification must be done in writing in an unambiguous manner, and it must be done on day 45. So this, ladies and gentlemen, is the trickiest part of the exchange for our clients, because a lot of clients will call me up and say, well, geez, I don't know what I want to buy, but it's going to be in Sacramento. So why don't I just go to the MLS and print out an entire list of everything in Sacramento, and that will be my identification letter? Nope, wrong. It does not work that way. The government gives us rules for how we identify on day 45. The most common method for identification is to use the 3-property rule. The 3-property rule states pretty simply, on day 45, you can nominate 3 properties, 1, 2, and 3. On day 45, once you submit your list of 3 properties, guess what? You are locked with that list. You cannot make changes or modifications or substitutions after day 45. So if property number 1 burns to the ground on day 46, you're out of luck. You've only got 2 left. If property number 2 gets sold to someone else on day 47, you're out of luck. You've got 1 property left, and if you cannot purchase that property to complete your exchange, you have a failed exchange. And guess what? A failed exchange results in taxes. Not the end of the world, right? But what we always counsel our clients to do is don't wait until day 45. Go out within the first 45 days and make offers, right? You can go and make 200 offers in the first 45 days, and hopefully you get something locked up. On day 45, it hopefully is just a technicality submitting your identification letter into us because you already know what you're going to buy. So day 45, very important. With the 3 property rule, you can nominate any 3 properties. Now, this works great unless you want to buy more than 3 properties, right? What happens if you want to buy 4 or 6 properties? Well, if your intention or client's intention is to buy 4 or more properties, identification on day 45 must be done using the 200% rule. The 200% rule has no cap on the number of properties. So in my example, I'm going to identify 6 properties. But the problem with this rule is that there is a cap on the total value of real estate. So unlimited number of properties, but we have a cap on the value. And with the 200% rule, the value of all of these properties, once you add them all up, the value cannot exceed 200% of what you sold. So your client sold a building for $1 million. They're going to identify with the 200% rule. That means they can identify $2 million worth of real estate. Now, you have a client who just sold in Palo Alto, and they're going to go out and buy in Texas. Well, they sold 1 property in Palo Alto, but they can probably buy 15 in Texas. So those clients are the ones that are going to use the 200% rule. Right? You sell in a very expensive area and you go to a place like Texas or Arizona where properties sell still for $150,000, $200,000. Those are good candidates for the 200% rule. And ladies and gentlemen, there you have it. Those 4 guidelines are going to get you through any conversation about 1031. Now, I don't expect you to remember everything. The purpose of this presentation is just to give all of you a refresher, to get you, some good talking points. And if you can remember those 4 guidelines, fantastic. But the most important thing to remember is you've got a team here now that's dedicated to supporting you and your clients on these issues. All right. And what we're going to do, hopefully, too, is I'd love to put together a little bit more in-depth workshops regarding some trickier issues that you see on your closing desk, like vesting and seller financing. But today's presentation is just for the kind of quick overview. Now, before we leave, I also want to talk about, as I mentioned, the other 2 types of exchanges. So most exchanges are done forward, where you sell and then buy, but you can, in fact, do what's called a reverse exchange, right? So the reverse exchange people ask about all the time. Can I buy first and then sell? Absolutely. Now, the problem with the reverse exchange is that the client cannot own the new property and the old property at the same time. So what happens in a reverse exchange is my company will come in and become the straw buyer for the replacement property. We actually buy this property right here. My company's on title. And then the client, once they sell their relinquished property, once they get that sold and they don't own it anymore, we then transfer the new property to the client. So a reverse exchange involves us becoming the straw buyer for the target or replacement property. Now, the problem with this structure is that, number one, lenders do not like to loan on them. So if your client's going to go out to Wells Fargo or one of those big traditional banks, their underwriting department is not going to approve this. All right, so they're going to have to either pay all cash, or they're going to have to go out to a private lender, or maybe if they have a really good relationship with the bank, they might be willing to do it. But most lenders don't like to loan on these reverse exchanges. If it's a commercial building, a big $5, $10, $20 million commercial building, the rules are a little different, so that might work. but most lenders don't like reverse exchanges. Okay, that's problem number one. Problem number two is that when we take title to this property, there's a transfer tax. And then when we transfer it to the client, there is another transfer tax. So in places like San Francisco and Berkeley, that can be $10,000, $15,000. All right. And then finally, our fee on a reverse exchange goes from a standard $950 fee to a $6,500 fee. So because we are on title to that property, there's a lot more work, but B, there's also a lot more liability for our company. So we charge more to do those reverse exchanges. But I talk to clients all the time about them. And today alone, I probably had 4 conversations about reverse exchanges. And generally what I'll do is explain these problems to the client, and then they can do a cost-benefit analysis to see if it's worth doing the reverse exchange. 9 times out of 10, they'll say, forget it, I'll do it the regular way. But every once in a while, we'll have a client that says, you know what, this still makes sense. And we're happy to do the reverse exchanges when they make sense for the client. All right, last exchange type. This is the construction exchange. The construction exchange sounds fantastic. You get to go out and sell a property. You get to buy some land or something, and then you get to use 1031 exchange tax-free dollars to build on it, and then you ultimately have your perfect replacement property. Right? Well, who wouldn't do that? Well, a lot of people won't do it because the time frame in which the government allows you to do this is the same as a regular exchange. That's right, 180 days. So you're gonna sell your property. The money sits with us. You use that money to buy some land, and then the leftover money you're going to use for improvements. And you got to get the money spent on completed improvements by day 180. Not going to happen, right? Not going to happen. What happens sometimes, though, is clients will use the excess money not to build from the ground up, but to remodel a bathroom or a kitchen, okay? And that can work. So the construction exchange is usually best suited for people who are going to do $50,000 to $250,000 worth of improvements, right? Because they can get that type of job done within that strict 180-day time frame. Does that make sense? Okay, so those are the different types of exchanges and the overview. Now, if we had a little bit of time, I was going to talk about one other thing, and we've got about 2 minutes. So what I wanted to mention here is that when you guys are out in the field or when you're at your closing desk, almost every deal you work on is going to have some kind of tax consequence. Okay, not all of them, but most of them, right? And the tax issues that are involved are going to fall into generally 2 categories, okay? People who are selling their homes, and they can be eligible for their homeowner's exemption, or people who are selling investment or rental properties and could potentially be involved in an exchange, right? So, maybe 80% of the deals that you work on, the clients will either be able to take their homeowner's exemption or do a 1031 exchange. All right, the homeowner's exemption, if you live in a property for 2 out of the past 5 years, you can avoid taxes, right? You can avoid $250,000 if you're single and $500,000 if you're married. Now, the 1031 exchange we just talked about, right? For your investment property, it's tax deferral. Now, there are opportunities, ladies and gentlemen, where your clients might use both of these exchanges on the same building, both of these tax laws on the same building. Now, let me give you an example. You have a client who is selling a 2-unit building. The client lives in the top and they rent out the bottom. You've got one escrow with one buyer, but you've got 2 different tax laws that are applied to the sale of the property. And this is a tremendously powerful tool, right? Your client's going to avoid paying taxes on the part of the property that he or she lives in, and then they are going to defer paying taxes on the part of the property that is a rental. So two different tax laws apply to the sale of that one building. So if you've got a client at the closing desk and they say, well, geez, this tax bill, oh man, I'm not happy about this tax bill. And they tell you, oh, we've been renting out the cottage in the back. Well, the 1031 exchange is a great way to mitigate or reduce that potential tax bill. All right. I think that's it. So it is 1:30 exactly. Look at that, right on time. So this is my information here. I don't expect you guys to remember all of this stuff. Hopefully you've taken some really good, bits of information that you can use with your clients. Feel free, though, to use us as a resource. You've got Matt, myself, and Wei Ming here available to you to help support your offices. We're working with a lot of your sales reps. I see Lori's on the call. We're working with a lot of the sales reps to get out in the field and educate the Coldwell Banker offices and any other offices you guys want us to get out in front of. So thank you guys for your time. I definitely appreciate it, and we look forward to the opportunity of meeting all of you if we haven't done so in person. And I want to also coordinate with Michelle to get maybe next month, another webinar training for you guys where we go over some more advanced issues like vesting and trusts and LLCs and how that affects a 1031 exchange. So everybody have a great rest of your day. It was a pleasure spending 32 minutes with you, and look forward to working with you guys all in the future. Take care, everybody, and have a great rest of your Tuesday.